Hi everyone, thank you for joining us and welcome to our webinar, Startup Founders Guide to ESOPs. Sorry for the delay initially, we've just had a few technical difficulties but all resolved now. So just to introduce ourselves, I am Georgina Toomey, so I'm a practice group leader in our corporate team at LegalVision, and I'm really pleased to be joined today by Mark Lodder, who's BDO's Tax National Leader.
Morning all.
So before we begin, we're just going to run through a couple of housekeeping matters. So firstly, you'll be emailed a copy of this webinar recording later today. We will do a Q&A at the end of the session as well. So if you've got any questions for Mark or I, then you can submit them into the chat box. And we'd be grateful also if you could please complete that survey after the webinar. So all attendees today are eligible to get a free legal consultation with us to discuss how we can help you with your ESOP or any of your other legal needs. So to ask for that free consultation, you just need to provide us with your contact details in the survey that appears at the end of the webinar. So to the content portion. So today, Mark and I are going to discuss ESOPs. So what we'll do is we'll start with basically a really broad overview of what they are and how to structure and implement them. But then we'll spend the bulk of the time focusing on what you need to be thinking about from a commercial, legal and tax perspective when you're deciding how to structure your particular ESOP. So what is an ESOP? Basically, this describes the issue of either shares or options in your company to certain people. So in short, it's giving away a certain amount of equity. For the purposes of this webinar, we're mainly going to focus on the issuing of options, which are really popular for high growth startups in particular, but which also need some really careful thought in terms of how they're structured. While also we'll continue to refer to employees in the webinar, that's just basically for simplicity. Just be wary that obviously ESOPs can be offered to a broader range of participants, and that can include your contractors or other people that might be delivering key services to your company. So before we kick off and to kind of set the scene, Mark, in your view, what are the benefits of putting in place an ESOP, particularly I guess in light of the current competitive employee market that we're in at the moment?
Look, before I start, I shall own up to the technical problems. That was my fault, and you're almost going to have a picture of the desk that's in front of me rather than myself. I'm not sure which would be preferable, but anyway, we are here and all is well. So the benefits, I guess, in terms of the context of a startup where cash is often very scarce. How do you attract the top talent if you can't afford to give them the cash reward that perhaps they're demanding? And like George said, especially in this market where the employee is really king at the moment. So the ESOPs or the sweat equity or whatever you want to call it, that's a very good alternative to increasing the remuneration and attracting talent. And then I guess, look, who doesn't want to be along for the journey? It creates possibly more excitement for the employee to actually see their efforts being rewarded accordingly. So what they do, they get direct benefit in return, and you get that from having ownership. So look, we see that a lot from a psychological perspective, because for tax we often talk about phantom share schemes and things like that, which really is a cash bonus linked to the value of the company. But we do often find that the employer really does want, and the employee rather psychologically wants to hold that piece of paper that says, I've got ownership in this and I belong. So there's some of the benefits.
Yeah, I think that's a really good point around the phantom share schemes, and we can get into alternative options later down in the webinar, but that's bang on in the sense of often we're having to tell the employers you need to really communicate and sales pitch this to the employees because they've got that thing in their head saying, I really want equity. That ownership mentality is really, really key in terms of driving that productivity in the company. So yeah, really, really good comments. And I think really important to kind of keep that front of mind as well as we go into the rest of the webinar in terms of why are we actually putting this into place in the first place. Awesome, thanks Mark. So look, before we move on to how we structure your ESOP. To set the scene, we're going to just discuss a little bit about what that process looks like. So on day one, options, and this is a real sprint through it, but on day one, options are issued to your employees. Either that will be once they've already proven themselves to be really a key performer in your company, or it might be as part of the onboarding incentive when they first start, which is exactly what Mark was talking about in terms of lifting their base remuneration. There's typically no cost attached to the granting of the options at that stage, but there will be an exercise price that's set at that date, and that's how much it's going to cost to later exercise them into shares. The second piece to this is typically to make sure that the ESOP has got that intended kind of commercial impact, I guess, of incentivizing retention and employee engagement. The options will usually be subject to some sort of vesting regime. And at a really broad brush kind of explanation of that is basically just a concept of earning the entitlement, so earning the shares. And that can be time-based. So, for example, if you stay in the company for 3 years, you'll get that full entitlement. It could also be performance-based. So if, for example, you are a tech company, you need a key developer with a certain set of skills to build out, I don't know, a specific part of your tech stack, then what it might be is instead the conversation is if you achieve these 3 KPIs, you'll get your full entitlement, but we don't actually care how long it takes. Well, you don't care if you stay for 3 years. If you achieve that in 6 months, great. And then obviously you can have a bit of a hybrid of those 2 options as well. And then lastly, the last piece to this is once they've been fully vested or fully earned, they can then be exercised into shares at that point. And that's the time where that exercise price that I spoke about earlier is paid by the employee. So again, it's set at day one, but ideally there's increased value attached to those options on the day that they are fully vested and exercised. There's another option, and we'll go into this again in a bit more detail later, but the company can also choose to not allow the options to be exercised until you have an exit event, at which case your employees just sit on their fully vested options until that date. And then, final comment on this is once they're exercised, that's when your employee now holds shares in the company, and typically that's the point that they are able to vote. They're entitled to dividends if you're paying them, and also a portion of proceeds on any exit event as well. Cool. So just touching then initially, just before we talk about, get into this discussion around the legal and tax considerations, the broader kind of scheme design components are worth talking about really briefly now. These are the things that you need to be thinking about given they'll impact how you structure your ESOP. So first kind of question here is, what are your objectives? Are you looking to attract key talent? For example, that tech developer example I touched on earlier, or is this more kind of intended to act as, an added bonus for all your staff to build company morale? So, questions there is, are you a startup in aggressive growth mode, or are you an established company turning profit consistently? The next question you're asking there is size. So how much of the company do you want to make available for the ESOP? And here you need to be thinking about your current staffing requirements, but also your runway of potential hires over the next few years to make sure that you build in enough headroom within that allocation. A lot of the founders will be thinking, well, hey, what's the dilutionary impact on me for doing this? But I'd caution against placing too much emphasis on that. The whole point of the ESOP, as we touched on at the start, is to build value in the company. So while you might have a slightly reduced holding, the idea is that that reduced holding has got an increased value to what it would have had otherwise. In terms of participants, we touched on that earlier. So will this be everyone in the company or just certain people? And again, does it go beyond your employees? So maybe there's a particular person with a bespoke set of expertise that you're wanting to sit on an advisory board. They might be someone that you might bring in on the ESOP as well as the form of remuneration for that role in the company. Governance documents, what you're wanting to think about there is, do you have a constitution or shareholders agreement in place? Are there any restrictions around issuing new securities within that we need to take into account when we're setting up the ESOP? Or maybe this is an opportunity to reopen your shareholders agreement to lock in those approvals. And then finally, you know, as you can imagine, there's quite a bit of management required in rolling out your ESOP. So typically would suggest you have one point person at the company that's completely across it. They understand how the plan scheme works, and they're able to answer all the questions that you get from your employees, as well as tracking, obviously, allocations that are made, vesting regimes, and exercising of them as well. Cool. So into the kind of chunky portion of today's session. So that's all very much just setting the scene. Now we're kind of getting into the nitty-gritty of, well, how are we going to structure this in a way that works both to incentivize our employees, but also from a company perspective. And we're just going to front foot it right now. So Mark, it's fair to say that, you know, tax applies and is really, really critical when we're considering how to structure the ESOP. Maybe we start off with, can you just explain to us, you know, how is that tax calculated and when is it payable?
Yeah, so in terms of your earlier slide, and you've got II, and III here, 1, 2, 3, might not look it, but from my perspective, I care about the exercise. It's when the options are exercised and we have shares. So for tax, actually, let me go back. These we've had rules around employee share schemes for as long as I can remember. Back in 2016. The rules had a complete overhaul for tax purposes. So there was a complete redesign, but it was more of a, when I say a complete redesign, it was tightening up the rules and making sure that there was a better ability for Inland Revenue to police and better understanding of the taxpayer as to what their requirements are or will be. So we've been on a bit of a journey of late, and certainly, as I said before, as cash gets tighter, we start to see more and more of these creep into the commercial market. It's a way of providing a reward, but without having the cash shortfalls or cash disadvantages. So in terms of the taxing point, we don't tax share options in New Zealand. We tax the difference between the market value of the share and the cost to the employee at the time the shares are acquired. And this is the tricky bit, and this is what happened back in 16-17, is there was a complete discussion on what's the meaning of when shares are acquired. So from an incentive perspective and from the employee's perspective in particular, the sooner they got the shares, the more they were able to enjoy capital growth of those shares, and that capital growth would be received tax-free. So the game normally used to be, or the obvious game is, we want to get shares in your hands for a price or a value that's as low as possible, noting that the price always goes up, or that's rather the underlying assumption is we're not going to fail with this, and with your help it was going to keep going up, and we want to put you in the position that we are in as founders or owners of the business, that any growth or upside can be enjoyed and received by you tax-free as capital growth. So we try to get the shares in the hands of the employee as quickly as possible. And this is where the acquisition date is really important. The term that's used in the legislation is the share scheme taxing date. And fundamentally, it can be really complicated, but if you simplify it, you own the shares for tax purposes at the time you can enjoy all the risks and rewards of those shares as any other normal shareholder. So you wouldn't have any of those KPIs or hurdles in place, i.e. you need to be here for 3 years, or EBITDA needs to exceed a certain percentage before you have that entitlement. So those hurdles will delay, or plus others, will delay when the employee actually receives those shares. So the obvious example, very simple example, would be if you've got a trust that acquires $10,000 worth of shares for an employee, and the employee is entitled to those shares in 3 years' time. the shares are received in 3 years' time, and the $10,000 is irrelevant. It's the market value at the time the shares are received, which will drive the taxation liability. Did that answer your question, George? I hope it did.
Above and beyond as always, Mark. Before we move on, a lot of I imagine people online will be thinking, well, okay, so at certain points within the scheme, then I'm going to have to be valuing my company. How do they value their company? What do they need to be thinking about from that perspective?
Yeah, no, I expected this one. Again, in the context of startups, so going back into 16, 17, this was a real problem, because a startup will go, I've got zero value, so I'm going to give you shares, but we'll just say there's zero value, therefore there's no taxation liability due. And when the legislators or the policymakers were looking at this, they were almost going down a route of a notional valuation for startups, or some sort of framework from which a startup would work within to catch those that are not playing the game properly. So luckily that got batted away. And in terms of valuing the shares, and again, I am focusing on startups, there's three avenues. You can get an independent valuation. You can so if you've had a capital raise in the 12 months prior to the issue or the receiving of the shares, you can use that as a proxy for market value. So that's the 12 months prior. So independent, 12 months prior, or you can use a valuation prepared by somebody internally that falls within a commissioner's approved valuation methodology, whether it's DCF or something else. But so there's a 1, 2, 3 there as well. So independent valuation, capital raise as a proxy, and then in-house, sorry, 1, 2, 3. If you've got either 1 or 2 already, you can't use 3. So you must use external first. So if you've got independent valuation or a capital raise in the prior 12 months, you must use either one or 2 of those valuations.
And fair to say there's some costs attached to that from the company perspective, and that's just a reality that they need to accept in terms of building out that valuation methodology.
Oh, possibly, but if you have had a capital raise, external parties come in, then that information's there as part and parcel of the capital raise process.
Yeah. So from my kind of breaking down of that sort of really useful information, the idea is obviously we want to get the shares in the hand of the employees as soon as possible, and for as low price as possible. We spoke about vesting earlier, and obviously from a company perspective, what we're looking at is to safeguard against people who get value before they've earned it effectively. And so there's kind of a bit of a tension there in terms of the commercial intent of the scheme, and also obviously trying to make it attractive to employees from their perspective and a taxing perspective. What are your comments on that? Is there a way that we can get both of those pieces satisfied?
Yeah, I completely agree. I think there is a natural tension between the commercial objectives and what you might want to do from a tax efficiency angle, i.e. we want more capital, less income. The rules, when they're redesigned, are to put the parties to the transaction back in the same position as if they dealt with cash. So the previous get into the hands as soon as possible is perhaps diluted, because the company, in offering the shares or associate, or whichever the employer or associate of employer, they are entitled to a deduction equal to the taxable income of the employee. So therefore, we've now, from a tax perspective, we've got maybe taxed at 33, 39 or whatever, but we've got a deduction in the company at 28. Therefore, we're playing with a different margin. So it's the marginal difference between those two, which is your real cash cost, if you like. The other angle to look at as well is the onus used to fall on the employee to make good any tax liabilities. Now there's a choice. So the tax liabilities can either run through the normal PAYE process and be borne by the company, i.e. the company will wear that 5 or 11% differential, plus the company will get a lift in its share capital. So it's deemed that we're extrapolating the barter. I give you cash, you use the cash to buy shares. So there's a lift in share capital, which is good for tax. We like share capital because we know under the right circumstances, we can pay that out tax-free outside of a liquidation. So those two angles there mean that perhaps the advantage of getting the shares to the employee as quickly as possible is not quite as great as it used to be, because now we've got the tax shield in the company. The other thing to mention is I said that there's two options. You can run through the PAYE process and the company pays the tax, or the employee pays the tax. Under either scenario, and remember I talked about policing and Inland Revenue's ability to find those that might not have hit the mark. If the choice is made the company bears the cost, sorry, the employee bears the cost, then the company still has an obligation to disclose the taxable income through the process, PAYE process, but doesn't pay the PAYE. Inland Revenue then tags the expected liability to be paid by the employee to the employee's IRD number.
Lots of information there, but incredibly helpful. And actually that's from a legal, that's really interesting, because from a legal perspective, when we're talking about getting shares into the hands of the employees as quickly as possible, it's good to see, I guess, that impact is diluted a little bit, because sometimes, you know, when we're talking to clients around when can you allow your employees to exercise those options, something that's really attractive is actually saying, no, you can't exercise them until an exit event, because that holds them at arm's length. They can't vote, they're not entitled to dividends, and from a cap table management perspective, that's actually quite attractive for a company, but obviously that comes with added tax liability. So it's actually good to understand, you know, I guess, the different aspects of it that you've discussed, because actually that doesn't become such a problem, I guess, in terms of what you're saying.
It's not, but those, I think it's for me, the commerciality should override the tax efficiency, if you like. You might be able to get more capital growth in the hands of the employee, but miss all your objectives in terms of incentivizing and encouraging. So
Yeah.
So be careful driving this from a tax hit.
Yeah, and look, I think that's a really relevant comment as well. Just before we move on, the other question I had sort of relevant to this as well is, in terms of the actual exercise price, we obviously spoke about that being set on day one. I mean, that's what they pay to get their shares. There's kind of two schools of thought here. Often the company will be saying, well, actually, to make this as attractive as possible to employees, I want that to be a nominal amount, so that they're effectively not having to stump up with any cash. The other perspective, or other school of thought is, well, actually, we are going to set that at market value at that date, and you will only benefit from the increase in value in the company between that date and the date of exercise, because that's the kind of true intention of this, is that you are sharing in the value that you've put into the company during the time that you've put into the company. What are your thoughts on those two kind of options that are available? It obviously goes to the valuation point as well.
Look, from a tax perspective, I'm just going to look at the difference. So the difference is, obviously, if the employee is paying nominal, the difference is greater. If the employee is paying more, the difference is smaller. Often we might see. So actually, I'll hold on that, because you might be getting to that in a bit, George. Yeah. So look, from my perspective, it's I can understand a lot of this, as we're talking about, is really around the psychology of both parties, employer, employee, and making sure you get the best out of both. So if nominal value is the way to go, then it's eyes wide open. we know that the difference is probably going to be greater than if it was set at a market value at 3 years prior.
Yeah, perfect. No, look, that's I think that's a really good place to kind of move on to the next piece then, which is just we're going to touch quickly on the legal considerations. Obviously, we've been talking a lot about the tax side of things and the commerciality of it as well. The legal side of things, there's only a few things to kind of comment on here, and we won't spend a huge amount of time on it. But it's just to basically raise the flag that there's a regulatory framework that applies to ESOPs in New Zealand. The key here is the Financial Markets Conduct Act. And basically, in short, when you're issuing securities in a company, there's pretty onerous disclosure obligations that can come with pretty significant time and cost implications, but there is an exemption that applies to ESOPs. So in order to rely on that, nothing there is prohibitive at all. It's just basically something that you need to be aware of. One key thing is that you are limited to issuing 10% of the shares on issue in the company in any 12-month period. Usually that's absolutely fine because you're not looking to basically allocate your full pool in a 12-month period. But one key thing to be aware of is that if you are looking to issue a different class of shares under the ESOP, so say a non-voting class of shares, your 10% becomes 10% of that particular class. So it's an easy trap to fall into and something to be aware of. There are other ways to manage voting rights of those shareholders without setting up a new class of shares. The next piece I want to touch on is that it's really key to keep an options register maintained on the company end. The management of the cap table comment there. So what I'm talking about there is if you are allowing them to exercise straight away on vesting, you just need to be considering, well, how big is the company? How many employees are benefiting from this? Is there a chance I'm going to hit those code company kind of parameters of there's a lot to it, but effectively 50 shareholders, 50 share parcels. So if you've got a number of employees coming in on the ESOP, just be wary of that. You might be wanting to look to set up a nominee structure to hold those employee shares on behalf of the employees, which helps you manage that potential risk. In terms of the documentation requirements, so you typically will have a base set of rules in terms of, well, how does this actually get rolled out? What are the rules that apply? You've then got your approval requirements from a company perspective, which obviously your lawyer can help you work through. And then you've got your bespoke offer letter that you set out the actual specifics of that particular offer. And you're also looking to tailor your governance documents, particularly to consider the fact that you might now have employee shareholders on board. So you need to be thinking about, what happens when they leave the company further down the track. How are you going to treat their shares on a leaver event? So before we go into Q&A, I just wanted to, give you, Mark, the opportunity to, have a bit of a chat to us around what are the common traps that you see that people often fall into that they need to be wary of and looking to avoid. Is there anything in addition to what you've already been talking about?
There is, and you set me up very nicely for that one, George. Thank you. Talking about levers. So this one, the good and bad levers. This is a real easy trap to fall into, and it does feel a little bit harsh. But let's use the example. We've got an individual. They've got the shares, and they've got all rights to dividends. They've got voting rights. There's nothing that's stopping them from enjoying those types of rewards. But if the employee leaves for any reason within three years, i.e. they're a good leaver, then the shares for tax purposes don't actually vest, or they haven't actually been acquired until the 3-year period is up, because the individual employee can't enjoy the rewards of any increases in value until that 3-year time frame hurdle has been removed. In contrast to bad levers, if someone leaves and is a bad lever, we don't care about that. So if you have a bad lever policy, which requires the employee to forfeit their shares, that's fine. But good lever policy isn't so fine. We've talked about delays. I won't go into that again because that's nothing new there. I think one thing to remember is just because you're not an employee doesn't mean a barter transaction isn't taxable. So the old absolute sweat equity, still got income tax, still got GST liabilities to think about, even though you're not an employee. Another rule will pick you up. Dividends. Dividends is a good one, i.e. no right to dividend until a later date. Again, you're not enjoying all the rewards of share ownership until you have that right to dividend. There's some funnies with dividends that you might want to have a think about. I'm sort of a little bit on the fence with it, but for example, let's say the nominal share issue, as George mentioned earlier, versus we're going to lend you the money at full market value and then you will use dividends to repay the loan. Under the former, you got taxable income because you bought for nil. Under the latter, you bought for market value. You've got a loan in place and then you use the dividend to repay the loan. That in theory is not subject to the rules because you've paid market value, etc. So those are things to think about with dividends. And limited recourse loans is another sticking point. So financial assistance, the company issues the shares for market value, provides a loan in return. However, the employee under a limited recourse loan is protected from any downside risk, i.e. the shares have got a value either equivalent to market value on exit or the amount of loan outstanding, whichever the greater. So the employee can never lose out. They're always going to be returned at least the minimum, or able to repay any part of the loan back. So those are areas to really watch for, and that can change the acquisition date for tax.
Yeah, that's fantastic. Incredibly interesting from our perspective as well. So look, thanks for that, Mark. That's really helpful. Now, before, excuse me, we are going to go into a bit of a Q&A session now. I have been building in some of the questions that we're seeing, just because it's obviously much more natural to build into the conversation that Mark and I were already having. There are some more questions that we have coming through, which we will come to. Just before we do, we've got our LegalVision publication on ESOPs available to you, so you can download that in accordance with those instructions that you're seeing on your screen. We've also got an upcoming event as well that might be of interest to you, so around trademarking, and that's on Tuesday, 15th of December, so feel free to register for that as well. So as we're waiting for the last few questions to come through, just some information on your screens now around our LegalVision membership, which is a really cost-effective alternative to the hourly rates that you'll experience with most law firms. And, you know, feel free to jump on the website to understand a little bit more about that as well. We've got a bit more time. And then on the next slide, we've got Mark's details as well. So feel free to reach out to Mark directly if you want to discuss your ESOP as well. He's very happy to take calls, I'm sure. So now into the Q&A. So one question that's come through, I'm keen to hear your thoughts on, Mark, is if I'm applying ESOP options to offshore employees, I'm a New Zealand company, I've got offshore employees, what do I need to be thinking about there?
For offshore persons, well, we need to understand whether or not there is a liability for tax for those persons who are receiving the reward. If they're not performing services in New Zealand, I would suspect that they're probably outside the regime.
Yeah, perfect. And then also from a legal perspective on that as well. So obviously, you know, your New Zealand company is subject to New Zealand securities law and the issuing of those options to New Zealand employees. But you just need to be very careful that wherever your employees are based offshore, you need to be ensuring that you're also complying with those local securities requirements as well. So typically what we'd do is if it's an area, sorry, a jurisdiction that we don't work within, we would then link you up with a local lawyer, and usually what you'd see is your offer letter at least will be tweaked for that particular employee to make sure that you are complying with those obligations. But good question, particularly for our startup clients in New Zealand. There's a lot of people working with offshore employees, so it's something to be very careful of. The next question I had here was, and this kind of, we've already sort of touched on this a bit, but I think it's probably worth going into a bit more detail, is how is the exercise price determined, and does it rely on a valuation? So I guess where we're going with there, we've obviously touched on valuations before and how to value your company. Talking about nominal issue price, exercise prices, and fair market value exercise prices. Does that have to be attached to a valuation, that exercise price? What are your thoughts on that, Mark?
Well, the exercise price is your lever to incentivize your employee. So the beauty is in the eye of the beholder here. The exercise price can be what you want it to be. It's working out the tax liability. We need a market valuation. But if you want to give some reward to the employee and have a discounted price or a nominal price, then up to you. That's the model, the commercial objectives, and then we use market value to work out the tax.
Yeah, absolutely. And from a legal perspective, it's relatively broadly, the requirements are broad in the sense of from a board perspective, as a director, you need to be thinking about and actually certifying that whatever price you've set is fair and reasonable to your company and to your shareholders. So you're not sort of massively undervaluing the value of those shares. Obviously, at a nominal share price, the argument there is, well, actually, we are getting, this is basically being paid for effectively by services provided by those employees. So you just explain that within your resolutions approving the price that you're setting. So there's a few different things to be thinking about there from, commercial, legal, and tax perspectives. Okay, so that's the 40 minutes. So that's all the questions that we have time for today. Don't forget, free consultation is available to you if you want to do that. Mark is also available as well. His details were provided a bit earlier on in the earlier slides. And look, thank you so much, firstly, Mark, for joining. I know I got a heap of value out of that. Hopefully everyone who attended today did as well. And thanks everyone that's joined us.
Thanks all.